Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. Today I want to talk about betting and investing and briefly introduce related subjects like risk and probability. I believe knowing about these subjects is helpful if you aren't sure where you stand and is required if you want to follow a structured approach to investing. So let's get started with some basic definitions. Investing aims to grow wealth predictably over time by taking measured risk with a positive expected return. Betting aims to win quickly from uncertain outcomes, usually without a repeatable edge. Note that I'm not saying here that one is better than the other. A good bet can outperform a bad structured strategy, for instance, but let's move on. These definitions introduce the terms risk and uncertainty, so we should also define them. A certain outcome is something you know for a fact will happen. Thus, an uncertain outcome is something you don't know will happen or not. Risk, then, is a measure of certainty or uncertainty, and we formalize it under another concept called probability. Probability needs a longer discussion, as it is the foundation for much of quant work. But for now, let's just define it as giving certainty a numerical form we can use to work with. So instead of saying, I am super confident that the sun will rise tomorrow, we can say the probability of the sun rising tomorrow is very close to 100%, or the odds are 99 to 1. A probability of 0% means an outcome is impossible. A probability of 100% means it is guaranteed. In practice, almost no real-world future event is truly 0% or 100%. Most things live somewhere in between. Numbers like 10%, 50%, or 90% just tell us how likely an outcome is, but keep in mind probabilities can and do change with time. Just because someone gives you a number doesn't mean it's true. A probability is only as good as the process that produces it, and that is a bigger subject we can cover later. But for now, let's assume your probabilities are correct. So how do they connect back to risk and to the difference between betting and investing? The goal for both the investor and the gambler is to end up with more money than what they started with, or in financial terms, have a positive return. The same goal can be rephrased as avoiding ending up with less money than what they started with, or avoiding financial loss or negative returns. Risk and its related probabilities can become a measure of financial loss. Extremes, which again are rare in reality, can help frame things. So here are two unlabeled situations. One, the probability of financial loss is 100%, so that's extreme risk and uncertainty. And the second, the probability of financial loss is 0%, so there is no risk and no uncertainty. Both the investor and the gambler will then like as little risk as possible, but that is only part of the story. Returns, time, and personal preferences are also factors, as we will see. A fascinating aspect of observing the markets is that they show an inverse relationship between risk and the corresponding reward. In general, the riskier the asset, the higher the reward. There are a few reasons why this happens, but people in general hate uncertainty, and markets must offer extra return to convince someone to hold risky assets. Another factor we need to consider is time, as the farther into the future an outcome is, the more things can go wrong. So in general, an asset or bet that takes longer to resolve will need to pay more. Investable assets and other activities can be arranged by risk, reward, and time horizon. This gives us another perspective where betting and investing can be compared. What's missing from this table is an instrument with low risk, high reward, and a short time horizon. We simply haven't invented one, and maybe it's not even possible. Equities, and I'm talking here about buying and holding stocks, gets close, and thus explains why they are so popular along with bonds. What's left are imperfect choices and a few questionable ones. Betting and day trading, for instance, cannot generate enough rewards to justify the risk, but as time is our most precious resource, they are very popular and sadly prey on the desperate. How to navigate these choices for the personal investor usually starts with an interview with a certified financial advisor that can set goals and individual tolerances to risk, and then try and match what's available to them. While this is not a financial advice channel, it is important to understand that risk profiles can change with age and other factors like local and global economic conditions. A final consideration here is that quants try to mix and match assets and strategies to achieve a certain goal, usually for institutions that need something that raw financial products can provide. As a hobby and craft, we want to try and find low risk, high reward, and short time horizon strategies in a structured way. How to do that requires we formalize and expand on the subjects we just discussed and will hopefully cover in future videos. This video started asking what investing and betting were, and along the way we found that they are points on a spectrum defined by risk, reward, and time. For the personal investor, knowing is half the battle, as they say. Knowing where you stand in the spectrum and what options are available should better inform your investing decisions. For quantitative purposes, probability, risk, and returns are some of the building blocks, and we'll explore how to use them in future videos. If you want more quant content, consider liking and subscribing to the Quant Matters channel.